So when trading stocks, some of the things that people get a little confused on are the order types. The most common one is going to be a market order. So that's if you want to buy or you want to sell something just at what the current price is. Just be aware that the current price, if you're buying, is usually generally around where the asking price is. And if you're selling, it's going to be where the bid price is. So sometimes there's a big gap between the ask and the bid. So just be aware of that. That might be a couple of pennies for something with a lot of liquidity, or it could be several dollars if there's not a lot of buyers and sellers. A limit order is probably the next most common thing that you'll see. If you're putting an order in when the market is closed, it's a really good idea to put a limit in because overnight stuff can change and the opening price could be very different. So if you put a market order in, you may be paying a lot more or you may be getting a lot less for your stock. So it's good to put a limit in. So what's the max that I'm willing to pay per share? Or what's the minimum I'm willing to accept if I'm selling the stock? And it'll give me that price or better if I put a limit order in. When you put a limit order in, if the price goes the wrong way, effectively you're not going to buy the stock. Next one are basically stop orders. So three most common I see are basically a stop loss, a stop limit, or a trailing stop. I used a lot of trailing stops. Generally, I'll use these to sell, but you can use them to buy. In a stop loss, say I bought stocks at $100 a share, and I don't want to go below, $95 a share. All of a sudden, the stock starts to go down. This would go at $95. It would go from a stop loss. It would convert over to a market order. Once that market order goes through, it's going to be whatever that price is. You don't really have any say in that point. It's just going to execute the order and sell it as quick as possible. On the other hand, if you have a stop limit order, you're going to generally sell it, and that sell is going to be triggered at whatever that price is. So say you go from 100 down to 95, you had that trigger price at 95. This now converts over to a limit order. Say you want to sell it at 95, but you want to make sure you get at least $90. So the limit, it would convert to that limit, and it would have to sell at greater than $90. And if it dropped to, say, $89, effectively that sale won't go through. So I like using trailing stops, especially if you're going to go on vacation or away for a little bit, and make sure that generally it'll be a sell, and basically you'll convert it to a market order if it goes to that stop. Now, how does this work with a trailing stop? So here we have our money, and here we have time. So let's say I bought a stock at $8, and I could either put a percentage trail or I could put a dollar amount. I usually just put a dollar amount. Let's say I buy it at $8, and I'm going to put a $2 trail. So each day it'll go up and down, and if it goes up, it'll reset whatever the price is. So now it's at $11 this day, and then the trail is $2 behind the 11. So if the stock goes down at any point below 9, it'll trigger the sale. It goes down to 10. When it goes back up to 13, basically now 13 minus 2 is going to be $11. So if it hits $11, it sells. Now it goes up to 15. So 15, the trigger is now $2 behind, or trailing $2 behind. So 15 minus 2 is $13. All of a sudden the next day something happens. Once the stock comes down to $13, this automatically gets converted to a market order, and it executes as quickly as possible and sells off that stock before it can lose more value. As long as there's liquidity, it'll get filled very quickly. If you have an asset that nobody wants to buy it, then it might go down further. So that's the risk you have. But just remember, anytime you buy and sell stocks, you can lose money. Nothing's guaranteed. So if you see day, this really means today, normal trading hours. So that would be on the New York Stock Exchange from 9:30 to 4 p.m. There are other stock exchanges, but I'm just using that as an example. But after today, that order is canceled. GTC means good till closed. Sometimes this allows you up to 180 days, and this is just normal trading hours. So I'm taking the New York Stock Exchange as an example. So trade those hours. If you trade outside of normal hours, if you do a day plus extended, that's today, plus pre and post hours. So if you do GTC extended, this is basically all of the normal hours. You're also going to have the pre and post hours. So the risk when you have extended, some order types don't work well with those. And the other thing is that you may have more wild swings in prices because you have lower liquidity. There's not as many buyers and sellers. And we have fill or kill. So basically that's you're going to trade all of what you want to buy at the price you want, or you're not going to trade anything at all. And it's going to be a few seconds. All or nothing. So all or none. Basically you trade everything that you want or if it can't execute, say you need 2,000 shares of stock and there's only 1,000 shares, basically it can't trade all, so it's not going to do anything immediate or cancel. Effectively, this is only going to be on the market for a couple of seconds, and you're going to trade for a few seconds. Whatever can be traded in those few seconds that meet the criteria, it's going to buy or sell that, and then within a few seconds it's going to be over. And then this fill or kill is effectively the all or none combined with the immediate or cancel. If you're looking to become more financially educated, I cover stocks, how to get mortgages, how to save money on taxes, how to invest, and things along those lines. Thank you for watching. Please subscribe and have a great day.